Hi there, so my name is Keith Griggs. I'm a chartered accountant and property tax expert, and I just wanted to talk a bit about property tax because a lot of people don't really know the ins and outs of everything. So just a quick brief overview. Time of filming is August 2022. So the problem is that there's not just one tax that affects you if you own property. There's multiple taxes you're exposed to and that you need to be aware of, because you might just try and minimise one tax, whereas you might actually be exposing yourself to many more taxes, maybe not now, but maybe many years or decades into the future. But it could be a substantial amount of tax you might be paying. So stamp duty, income tax, corporation tax, capital gains tax and inheritance tax. They're the 5 different types of tax that would affect you. So starting with stamp duty, SDLT, stamp duty and land tax. So this can be substantial, especially for more expensive property. Now if you buy a property to live in your own name, it's currently it's 3% cheaper. So these are the rates if you buy property in your own name to live in, and then you have to add 3% more if it's a second property or investment property, or if you're buying it in the name of a company. So it's either way, the top band is, could be 15%. So it's a lot of money, especially because you have to pay this money up front on purchase. So it can dramatically affect buying properties. And it could affect you if you want to transfer property from your income structure to another. For example, if you own properties in your own name and then you have a company and you want to transfer them from yourself to a company, then the company may have to pay stamp duty unless you get some form of exemption. So it's definitely something you have to bear in mind. Income tax is another big one. Income tax on your rental income. So income tax, your personal allowance, which is tax-free, is about 12,500. The next 37,500 is at 20%, and then it's 40%. Now you're probably aware about Section 24, which our friend George Osborne brought in. Now this means that you can only whatever mortgage interest you're paying, you can only get 20% relief on that. Whereas if you're a higher rate taxpayer, you'll be paying 40% or even 45% on your rental income, but you get that relief for only 20%. This may not amount to much if you just got 1 or 2 properties, but as you grow your portfolio, this can really be substantial. So thank you, George Osborne, for taxing property landlords in this way. It was announced in 2015. Now, the big thing about it is it only penalises properties held in your own name. If you own the property in a company, this doesn't apply. So by doing this, he's given a massive incentive for people to start buying property in companies instead of in their own name. Corporation tax. So currently it's 19%, which obviously is lower than both the 20%, 40% and 45% bands of income tax. But then we have this problem of extracting the cash from the company. If you keep the money in the company and just reinvest in new properties, then you are better going the company route and only paying 19%, even apart from the Section 24 issue. But supposing you want some cash yourself to live off, then different ways you could do this: salaries, pensions, directors' loans, dividends. So let's go through these. Salaries, so obviously there's your marginal income tax rate, which is already discussed, but there's also these hidden, which effectively tax, which we call national insurance. Employees' national insurance is 13.8%, and employees' national insurance is up to 12%, so it's a substantial extra amount. So it's best not to pay yourself too much salary. Now, SIPP and SSAS pensions are excellent because pensions are tax-free, so you save all those taxes you'll be paying if you have it as a salary. And also SIPP and SAS pensions can invest in commercial property. When you and your partner die, it disappears, but there is some leeway in how you set it up, about whether it can be transferred to future generations. Directors' loans. So you might think, well, instead of my company paying me my salary, why not can't my company just lend me the money? And that's fine in the short term, but it does have to be repaid 9 months after the year end. Otherwise, no one would ever pay themselves a salary or dividend. They just keep on lending themselves. The company would keep on lending the owner more and more money all the time. So it needs to be repaid 9 months after the year end, or there are penalties. Dividends. This is an okay way to extract money from a company. 2,000 allowance, so the first 2,000 is tax free, then it's taxed at various rates. So this is depending on whether you're a higher rate taxpayer or not. So these rates, they're sort of designed to compensate you to make it equivalent of a sole trader and you earn money in your own name, or if you do it through a company and pay yourself dividends. So then in which case the company would pay corporation tax of 19%, and then you get these rates below. But Section 24 has changed all that. Section 24 means it's actually better to do it through a company most of the time. Capital gains tax. So when you dispose of a property, now disposal can be either a sale or a gift or a transfer into a trust. So any of these is a taxable disposal, and you would have to pay capital gains tax. So many people think this is unfair, because if you're giving it, why do you have to pay tax when you give it? Well, it's the way it is, so we have to live with that and make appropriate decisions how to the best course of action. So to calculate the gain, you look at the sale price. Now if it's a gift, then there's no actual sale price, so then you just look at what the market value is at the date of disposal, and then you have to take away the effective cost, and you'd be allowed to add on to the cost any extra capital costs, e.g. extensions. So the market value on disposal minus your cost is your gain, and that's what you have to pay tax on. Now if it's owned by an individual, you have to pay, you get an exemption of 12,300, so that's totally tax free, but of course most gains on property are a lot more than that. And then if it's residential property, you have to pay either 18 or 28%, depending on whether you are a higher or lower rate taxpayer, or if it's not a residential property, then it's a bit lower, 10 or 20%. In other words, it's substantial. Now, one thing about holding property in your own name is that when you die, then the cost, the original cost, gets uplifted to the market value at your point of death. So it's a great tax planning event. Death is actually a great tax planning event. But if the assets are owned by a company, there's no such uplift. Gain charge. So if an asset is sold or gifted by a company, the gain is just charged at a flat corporation tax rate of 19%, which is lower than the 28% if it's owned by an individual who's paying a high rate of tax. Inheritance tax. Now obviously when you die, this is charged on your estate and effectively paid by your beneficiaries. So obviously we would try and reduce their tax as much as possible, because we want to help our beneficiaries. So it's something that is worth considering. And the flip side of this is you may inherit property yourself from people. You may be expecting to inherit property, maybe from your parents. So it's a good thing for you to know about, and maybe discuss with them to see if there's ways you can reduce this, both on the assets that you pass down to your estate and also any assets that you may inherit. This can be up to 40%. So Exempt from this are any gifts to your spouse, civil partner, charity or community amateur sports club. Also exempt are any gifts you give away to anyone 7 or more years before your death. Now, of course, we usually don't know the date and time of our own death. So it's hard to predict if we're going to die within 7 years or more. So it's better to actually, if you're thinking of giving stuff away, it's better to do it sooner rather than later, because you never know if you're going to die in the next 7 years or not. The first £325,000 of value of your estate is exempt. You just pay tax on amounts more than that. Also, any assets held in a discretionary trust are also exempt from inheritance tax because they don't belong to you. They're sitting outside your estate. So this is one of the values of a discretionary trust. So this is would mean it's actually a good idea if you're thinking about minimising inheritance tax. One good strategy is to transfer assets, and maybe you don't want to actually give them away. Then maybe put the assets into a discretionary trust. Then they're outside your estate, and then there'll be no inheritance tax on it. We do have a 7-year rule, so if you give assets away within 3 years of your death, then you would have to pay the full 40%. If it's in 3 to 7 years, then there's a sliding scale, and if it's more than 7 years, there's no inheritance tax. So yeah, do you know anyone who may leave assets to you in their will? So good to have a chat with them about it maybe, and look at different ways to minimise inheritance tax, or you could lose basically 40% of that inheritance. And one good way is we'll come on to, I think, just maybe this or another video, but I'm looking at freezer shares. You could have alphabet shares, and one class of shares, all the growth go into a discretionary trust, and all the other classes of shares are freezer shares. So all the gain in value after you set them up at that point would just go into the discretionary trust. So it is a bit of a jungle of information. There's so many different things to consider. A lot of accountants are not really very well specialised in property tax. They just know a bit about some of the things, but you've really got to be a master and have a good grasp of all 5 things working together, and to know all the ins and outs, the details, all the different exemptions, and we'll do lots of calculations and work out the best way to structure things for you, because everyone's situation is unique. And then also another thing is to maybe transition between if you've got properties in your own name, think of how you can get them into a limited company, especially one with alphabet shares or discretionary trust as well. That'd be the ideal, but to try and get them into your into that structure without paying excessive capital gains tax or SDLT. So it is important to consider, and it's important to consider now, because the longer you leave it, properties grow in value, and it just becomes more and more expensive to move things around because there's more CGT and SDLT to pay. Anyway, I'm always happy to have a chat. Please get in touch, redboxfinancial.com, and hopefully I'll be able to help you minimise tax.